Yeah, hi there. Welcome to the home office. My son is the producer of the video today, and he will also edit the video. So these are obviously unprecedented times. So it is March 18th. It was another tough day in the market today, and I just wanted to give you an update on the several videos that we've been putting out in the last 3 weeks. So what has changed? There's obviously the tone has changed in the market. Really from 2 weeks ago. The key part here is that we are now in a full-blown run on liquidity and we have a credit crisis. So before we were just dealing with, what ifs relating to the virus. How quickly is it spreading? Are we containing it? Can we contain it abroad? Now we are not only fighting the virus here domestically, but we're fighting a two-front war, which is really in the markets, which is liquidity and credit, and in the society, which is to fight the virus. So, this is something that we didn't expect, certainly 2 weeks ago. And the canary in the coal mine here is really oil prices. So why oil? So what happened 10 days ago at OPEC was sort of an unprecedented event. So basically the Prince MBS of Saudi Arabia basically walked away from the cartel. All members were told, go ahead and produce as much oil as you want and let the chips fall where they may. So what happened to oil prices was a 50% drop in oil prices, and that created a domino effect of events in the financial markets that we are still reeling from today. So why is oil important? So since the 2008 crisis, we've had a lot of dollar-denominated debt being issued around the world. And a lot of that debt, high-yield debt, is actually tied to oil. So if you think about our oil industry, the shale industry that's down in the Permian Basin, which is in Texas, and also the shale industry that's up in the Bakken, a lot of that oil production is very capital intensive and is being financed by debt. So if you think about the covenants in these loans, typically you need $45 oil to create free cash flow to service this debt. So as of the closing today, oil closed at $26.47. So that's obviously far below the break-even points for our shale industry. So what's happened there is the whole credit market has frozen up, very similar to what happened in 2008. So if you are in the need for credit, it's very difficult. If you own bonds, if you want to sell a bond, the bid-ask spreads that you're seeing in bonds have gotten very wide. So you think you have a bond that's selling at 100. By the time you want to sell it, it is actually only worth 80. So what the policymakers are trying to get their arms around right now is to create liquidity into the system. So the good news is we've learned from the 2008 financial crisis how to inject liquidity into the system. If you think about the way the financial system is operating, we've gotten a lot better about that. So we have to give credit to the administration to act very quickly in terms of creating liquidity for the banking system. Basically, the Treasury has given unlimited liquidity into the short-term lending part of the financial system. That's the repo market. So if you are a bank, you're in need of overnight borrowing, you can tap the repo window. That's the term for that. That basically guarantees that our banking system continues to be well funded. So the banks, all banks have been painted with the same brush here. Bank stocks like JP Morgan, Bank of America, Citi, they're all down a lot. The good news is after the 2008 crisis, these banks have been very well capitalized. It seems completely ridiculous to me that a JP Morgan or a B of A or Citi would sell, at 6 times earnings or 5 times earnings in some cases, given that they are completely overcapitalized and their exposure into the energy complex is actually quite low. So that's not the case in Europe. So the credit blowback, if you want to call that, is affecting European stocks much more than here. The banking sector is still woefully undercapitalized. Ground zero there is obviously Italy, not just in terms of the virus. I mean, they are going through hell there when it comes to virus cases and deaths. The banking system in Italy has the largest percentage of non-performing loans. So obviously, if you're in the financial sector in Italy, you are getting the worst of all worlds at the moment. So the good news is, again, as I said, policymakers know how to deal with this. So we would expect TARP-like activities from policymakers. TARP was the massive program that was enacted after the 2008 crisis, which basically recapitalized not just banks but all sorts of industries. We would expect a lot of that type of news to come out in the next couple of days. The good news in Europe is, if you look at the biggest economies there, Germany has a budget surplus and a trade surplus. So the Germans have plenty of money here to jump in if needed, and certainly they will do that. So look, policymakers are making a lot of progress here. Look, the efforts to contain the virus have obviously been mixed here domestically. We missed the boat on testing, so our only fallback at this point is really containment. That means we have to shut down the main parts of the economy down to basically keeping things open that relate to basic goods, food, utilities, and so forth. The good news is the digital economy, a theme that we've been talking about for quite a while now. The digital economy can continue to function. So if you think about financial services, social media, cloud computing, that whole industry will continue to prosper. But it will hurt certainly consumer, leisure, anything like that, services, that will grind to a halt for a considerable period of time. On the policy side, we are also seeing a pretty large response now from the fiscal side. We are seeing indications by policymakers in Congress, working with the administration to enact TARP-like fiscal responses. These programs and this money is there to basically safeguard the most vulnerable parts of the economy. We've seen this in France already as well. The French government has basically shut down the country and has basically given fiscal support for even payments of rents and utility payments. These are the types of things, unfortunately, we're going to see all over the world. So, liquidity and credit, I'm less worried about that part of the policy response. We know how to deal with that. I mean, the duration and depth of the recession that we're going to see as a result of the shutdowns from the virus, that's the uncertain part. So that's something we can't forecast at this point. So what are we doing in the portfolio? We are obviously trying to limit risks that are quite obvious in the portfolio. Consumer discretionary companies that like Ulta Beauty. Look, Ulta Beauty was a great company that we've owned for a while. Great growth, but people are not going to be visiting salons or visiting stores, makeup stores, where there's a lot of interaction between people. So Ulta just announced they're closing their stores. We have no idea when they will reopen their stores. This is a very hands-on business, so this is the type of exposure you don't want in a portfolio right now. Disney is another example. Obviously, the theme parks in places like California are shut down. Also in China, they have cruise ships, they have hotels. 40% of Disney's business is tied to that area. It's just unlikely that anyone will be not responding or changing their booking habits, I would say, in the next year or two when it comes to this kind of exposure. On the positive side, food retailers are actually doing quite well. I mean, if you look at companies like Amazon, they own Whole Foods. They've been quite proactive to make sure the supply chains are working properly. So any of these omni-channel kind of food retailers that have capacity and scale will be beneficiaries of this. Amazon is one, Costco is the other. Companies like Walmart are actually seeing a lot of demand, and the stock is acting very well. On the healthcare side, several of our names will be household names by the time this crisis is over. So I'm talking about companies like Regeneron. Regeneron is a company we've owned for about a year now. It's the leading biotech company in the genomics and immunotherapy side. There's a lot of news obviously floating around on vaccines. Regeneron announced last week that it is now in phase 1 trials for a vaccine for the coronavirus. If you remember, Regeneron was the company that was in the forefront of developing a vaccine for the Ebola crisis in Africa. So they have a very good track record getting the right vaccines out and quickly. So the CEO of Regeneron mentioned last week that the vaccine would be ready by August. I would not be surprised that they get this out a lot quicker. Again, the competitive edge that Regeneron has over other companies, they are the company actually that invented a mouse that replicates the human immune system. So if you can use a mouse to test certain vaccines before they go to phase 1 trials in humans, that's a real competitive edge. So another company that's been in the news is Thermo Fisher. Thermo Fisher is a company that's in the process of buying QIAGEN. That's a Dutch company that is the leading producer of reagents. One of the problems we had with the CDC test kit was the reagent. So the good news now is companies like Thermo Fisher are producing those test kits with the proper reagent. The other company that we own is Roche. It's a Swiss pharmaceutical company that owns the biotech company Genentech in California. They just got approval for by the FDA for their test kit, and they are shipping 400,000 tests now out into the population. The other company that we own is Becton Dickinson. Becton Dickinson is the leading supplier of ventilators. The problem with the virus is it attacks your respiratory system, so if you have any chance of survival with acute cases, ventilators are a key product. The other company that we're involved with that will be also seeing a lot of demand is CVS. The pharmacies are actually serving as a bridge to get certain products, certainly pharmaceutical products, to the population. Hospitals are not going to have enough capacity to service its clients. Healthcare clinics run by CVS and so forth, outpatient type activities will be very important in this outbreak. The fifth stock that we own is Abbott Labs. Abbott Labs was just issued by the FDA emergency use authorization for its molecular test for the coronavirus. So now we have 3 companies that we're involved with, Roche, Thermo Fisher, and Abbott Labs, that are very much involved with testing kits. So at the close today, we did have some good news. So it was interesting to see that 10-year treasuries, the yields actually started rallying. So if the yield curve starts steepening, that is a signal out of the bond market that economic conditions may be improving in the future. So, you know, the 10-year treasury was way below 1% just about a couple of days ago. We're at the 1.2 level right now, which is a massive improvement. So if we also look at oil prices, as we said, oil prices were all the way down to 25 midday today. They rallied into the close. That was also good news, and I think that's also what rallied the market just into the close. So we'll continue to keep you updated. Stay safe, and we'll see you in the next video.